Good afternoon and a warm welcome to everyone. It's a pleasure to be here moderating this discussion on the most sensational topic at the moment. Today, we have two esteemed speakers with us. So let's welcome Mr. Jamal Mecklai, a renowned veteran in Indian FX market and Managing Director, Mecklai Financial Services Private Limited. And joining us alongside Mr. Mecklai, we have Mr. Kunal Sodhani, Vice President, Global Trading Center, Shinhan Bank India. He's currently driving and managing global FX and financial derivative desk at Pan India level. His views and analysis on financial market is widely published and recognized in various financial newspaper, financial channels, and many other media platforms. So today, both of them would provide their individual perspective on how domestic equity markets and the rupee will behave after election results are out on 4th June. Now, let me clarify one thing over here. A sort of a disclaimer you may look at it like that. We do not have any political analyst on the board at this point, so we will cover all possible outcomes that we may have, and which can be classified into broadly into three scenarios. The first one, wherein BJP wins an absolute majority on its own. Now, this will include the claim of Ab Ki Baar 400 par coming true, and perhaps a more realistic scenario of BJP on its own getting 280 plus seats. So that's scenario number one. The second scenario where BJP with its allies, NDA wins an absolute majority, and the third scenario where scenario of change in power with opposition alliance winning an absolute majority. So we will discuss how markets will react in each of these scenarios. However, before we start with this main agenda of the discussion, let's acknowledge the fact that Indian markets are not insulated from global market factors. And at this moment, this global market is actually sitting on a cusp of interest rate change, some unending global issues. Of lately, you all would have observed that with each critical data release, the expectation of the extent and the number of cuts by Fed is changing. For example, just last week, we saw FOMC stance going more hawkish and expectation of the rate cut being postponed further. So, Jamal, so my first question to you is, how do you see US interest rates and DXY move over this calendar year? To you, sir.
Thank you, Dipti. So, as she said, we're going to talk about the rupee and really about the elections. But in the context, what happens globally, we can't change that, right? Now, my personal belief is that US interest rates are actually, we're going to get back into the mode of what they call higher for longer. The reason I say that is I think that the Fed's target rate of 2% inflation, I don't want to say never, but it's not going to be met. And I think that's because there's that target was set in another world or another planet. There was such a thing called the China price that everybody talked about. Globalization was in full sway. So your supply chains were smooth and easy. Now, all of that has changed, okay, China is once more beginning to cut prices. But basically, my sense is getting to 2% inflation is going to be again, I don't want to say never, but well nigh impossible. So what that means is the Fed is caught because in their head and in what they have said, they are going to try to get inflation to 2%. So to my mind, what is going to happen is that rates, and the market is also beginning to see that rates are going to remain higher than people believed, certainly higher than people want. And of course, the equity markets are already reacting. After the Dow peaked just above 40, it's come down sharply. I've been feeling for some time that the Dow has to fall a lot. Maybe this is the beginning, I don't know. And so I think interest rates are going to be high. Now that doesn't translate necessarily into the DXY deal. Again, it's been in the market long enough as I have, you realize that it's not a switch. I mean, sometimes when interest rates go up, the dollar goes up. Sometimes when interest rates go up, the dollar goes down, as we have been seeing recently. And my personal, and if you look at the cycle of raising of interest rates, when interest rates peaked in the US, when DXY peaked, I should say, interest rates were about 3%. Now interest rates are now over 5%, and DXY is actually lower. So my sense is it's conceivable that DXY will become more volatile and come down.
Okay. All right. Good. So on the same subject, same point, Kunal, before I come to you, just one update for our viewers and our listeners. That while we want to keep this, I see some of the viewer participants raising hands. So we do wish to keep this session as interactive as possible. So we have kept a dedicated Q&A session at the end. But meanwhile, feel free to post your questions in the chat box, and we will address it at the in the. So yes, coming back to to you, Kunal. So what is, I mean, what is your take on global interest rate trajectory, and what would be its implication, particularly on the flows into Indian markets, equity as well as debt? So what's your
Right.
take on that?
Thank you so much, Deepthi. And it's a pleasure to be sharing a dais with Mr. Jamal. So I am a huge fan of him as well. So first, coming back to the state question, one, obviously, let's go back when the Fed started thinking about cutting rates. So that was December 2023 when the Fed policy came out, where Jerome Powell, during his press conference, clearly stated that they may look forward for 3 rate cuts in the year 2024. As in when the announcement came into picture, certain data points in the month of January came and people started being more dovish. By people, I mean the market participants, where they started discounting 4 to 5 cuts straight away for the year 2024 itself, followed by 25-26. That's a separate case. But coming to 2024, as in when the data points came in, particularly the inflation still remained sticky, the unemployment data still remains strong. The recent consumer sentiment data again was stronger. So taking the data points into cues, there still remains confusion between when the rate cuts will start. So initially, so if you see the SOFR curve itself, the SOFR curve started drooping towards the left. But as and when the data points started plugging into picture, the members itself, the Fed policy members itself started being hawkish. And Fed is someone who actually prepares the market first. They don't surprise. I have never seen them surprising in, and they're not even aware, they're not even making the markets aware that what are they planning. Similarly, if we see the FOMC minutes which came out recently, the voting members particularly were quite hawkish, and they still remain of the view that inflation still remains a concern. Also, one thing which I want to add on to Sir, he stated that we are moving and it's not easy, or it seems difficult to go for a 2% inflation target, which I completely agree to him in this scenario, where inflationary pressures due to several reasons will be on the higher side only. Thus, for a central bank to decide to cut rates is not easy because they cannot be indecisive. If they start cutting rates basis on the market expectations, it may possibly not work into that manner. Secondly, the slew of speakers have been quite hawkish. So personal expectation of rate cuts for this year only goes to one for me by the Fed. But on the similar lines, if we talk about the European Central Bank, there is a quite long divergence between the Fed and the European Central Bank. Their inflation data has been lower. Their PMI data have been brilliant in the last 3 months. They're moving towards a growth trajectory. And thus, I feel now the central banks usually in the past used to be of the nature to follow Fed. But now every central bank is working independently. For example, Switzerland or Mexico, they cut their interest rates recently. Similarly, I believe now it's about the independence of central banks, and European Central Bank possibly may look forward for a cut in June or July. While coming to the RBI perspective again, because obviously we're discussing on the domestic front also, I feel I'm not eyeing any kind of rate cut for the entire year. Food inflation still remains very sticky, though our CPI number looks lower and comfortable in the band of 4 to 6%. 4.83 was a recent print. But if you see the vegetable inflation, we saw a spike of 27% as compared to the last number. So monsoons will be an important take. And possibly moving ahead, I think, I don't personally feel that this could be one of the reasons of the rate cuts. But one thing, when you asked about flows, which is your second question, I think India remains a growth story when it comes to flows, considering three important factors. One is the next month we are starting with the JP Morgan, where Indian bonds are getting included into the JP Morgan. So we see an inflow of around 24, $25 billion, though in a staggered manner. That is one. Second is obviously we are also a part of the Bloomberg index, which will start in January 2025. Third, I think we have signed a couple of FTA agreements where I personally believe that if the European FTA and the others like Australia, UAE may take into place, a lot of investments will come into India. And lastly, I think the Brandywine investments, and there are several others who are moving their investments or reallocating their investments from China to India from the bond perspective. So from the debt perspective, I remain optimistic. From the equity perspective, obviously, I would still consider it as hot money. So there may be, peaks and troughs where we may see. But all in all, India possibly for me personally remains a growth story. Last concern on the flows is FDI flows, which remains a concern because if we see the FDI flows, which are the permanent source of income or permanent, which stays permanent in the country, have dropped since couple of years. So if you see the last data, we have dropped from $26 billion to $15 billion, almost a 45% downfall, and from April to Feb 24 versus April to Feb 23. So after elections, I think that if the stability comes into picture, FDI flows are quite important to watch out. Yeah, over to
I'd
you.
like to add on that issue, the FDI flows, because I read somewhere that actually the net FDI flows are even lower.
Yes,
In other
absolutely.
words,
Yes.
people are, sending, they're sending their investments back or their dividends or whatever. And I think that is really an issue. So we are living, in a sense, on, quote, hot money. The good news, as you said, is the bond indexes, because that money is going to come in any case, maybe not immediately, but over time.
Yeah, over to you, Dipti.
Yeah, sorry, I was on mute. I didn't realize.
No worries.
Yeah, so while we are discussing the critical factor of interest rate trajectory and how it will unfold going ahead. Apart from interest rate factor, issues like geopolitical tensions, any escalations in Middle East, these are another cause of concern at this point of time. So Jamal sir, how do you see it affecting equity market and more in particularly oil? Because if you see with all the drama happening in Middle East, oil is actually not moving. So what's your take on that?
Frankly, this is something I have been wondering about. I mean, has oil ceased to be a significant number? I mean, is it related to the fact that there is so much investment going into green energy? Many, many years ago, I think when 2.5 years ago, when Russia started their madness in Ukraine, I said, boy, if oil went down to $20, Russia would have to pull out. But that hasn't happened. But it certainly hasn't gone up. So, and as you know, the sort of uncertainty, I mean, with Israel and Palestine, Iran in the act, it's really, many, many years ago, oil would have shot up by 20, 30, $40. So why hasn't it done that? Which is your question. And frankly, I have the same question, I mean, it would seem, nothing is obvious in markets. It would seem that basically something has fundamentally changed about the global importance of oil. I'm thinking, perhaps this really is, as I said, related to the whole shift to green energy. If you look at non-ferrous metals, for example, they've been zooming because there's, huge requirement in electric cars, et cetera, et cetera, et cetera. So, frankly, I don't have an answer. Kunal, what about you? What do you think? Why do you think oil is asleep?
So I think one of the major reasons, so obviously it's a good news for us, I would say, because
Yes.
ultimately a lower oil definitely helps us, and we have almost 70 to 80% of imports. But then I think the geopolitical tensions are more of feeds, I would say. Some are internally linked, which I think the market participants, like the hedge funds, particularly understand. And usually, if I see the last 3 to 4 elections, which is the US presidential elections I'm talking about, this story starts peeking into picture, where the geopolitical tensions speak up and US tries to get into the picture to win that vote share. That's my personal reading, and which the market participants possibly discounted to a large extent. But for us, I think it's a good news, because I think every $10 drop into oil prices is reducing the current account deficit by almost 0.3%, which obviously, in fact, even the CPI by 0.3% to a large extent. So this is a happy news for us. Technically, also, if you ask me, I think a 91 to $97 per barrel usually acts as a very, very crucial resistance when it comes to crude oil. Secondly, I think we also benefited because of Russia, as you rightly started with it, because I think that's again a very good point when it comes to election. And when you talk about our government at the current stage, took a right decision of not being emotional about not importing oil from Russia. So we started importing oil from Russia, which also helped us. So if you see the numbers, particularly, I would just like to highlight, for example, the current account deficit. It dropped to almost $10.5 billion. If we talk about the GDP and the IIP numbers, that has also improved to a large extent. And even the rising manufacturing PMI data, so all which has linked of oil somewhere, like for example, manufacturing has chemicals and many other factors which has cooled off, and this PMI numbers has been rising. So I think it's a good news, yes. But as I said, from the global perspective, it still remains a hazy picture because of the US presidential elections, particularly.
Right, right, which would be at
Yeah, so November
Yes.
we have this
Right.
US presidential elections.
So, I mean, both of you have given your take on, what is happening with oil. You also mentioned about the non-ferrous metal and the other commodities. What about gold? Because if you see, gold has been quite volatile over last couple of sessions. We have seen some minute correction. So, what is your take on gold? How, I mean, when you link it to the inflation, how do you see it panning out going ahead?
Gold, I mean, it's nuts, right? Today at 2,400, it is double the price of take the gold out of the ground. So frankly, I don't think it's sustainable. Even though I had called a rise in gold about 4 or 5 months ago, part of it is because of the sanctions on Russia. Lots of central banks have been buying gold, but they're not going to keep buying at this price. India will stop buying at this price. So I think gold is probably peaking. Now, there is another strange thing that's happening in markets. Markets are saying, or analysts are saying, that if it looks like US interest rates are, if US inflation is coming down, gold would go up. Now, gold is traditionally a hedge against inflation. So it makes no sense that if the expectation is that if that US inflation is coming down, gold should go up. So what I think really is one of my thoughts had been as to why gold started going up is because markets were really worried about Trump. And, nobody knows what he will do. I mean, that he is nuts is well accepted. So if Trump, and I really thought that that's why gold went up. I may be wrong, but if you really can get into a situation that is high risk because the high uncertainty, and as I think about it, it could be even more so if Trump does not win, because he's certainly not going to sit quiet. So perhaps the only explanation I can think of for gold having gone to this level and holding at this level is there is concern of, what do they call those, a real, I won't call it a black swan event, but something really dramatic coming. I think basically global equities are going to crash. I don't know when, but I think they are.
Do you think by any chance there will be some connection to the de-dollarization talk and fear which was going on? I mean, do you
See, the dollar is the dollar. I mean, you can't really replace it. But and basically, it takes time. It takes a long time. We have a client who does sort of this UPI stuff in small countries like Sri Lanka, etc., etc. So thoda thoda hota hai. One thing I read though that was quite extraordinary to me is that the bulk of China-Russia trade is denominated in either yuan or rubles. So there are moves, no question about it. So, maybe we are coming to some sort of strange nodal point in global markets. But I don't think it's going to be on Wednesday. It'll take a little time. Kunal, I'd like your thoughts on that. What do you think?
So I have two takes. One, talking about de-dollarization. I think, as you rightly said, it's a very long story. For example, China has been trying to do since last 11 years. They have been trying to do that. So even if you see, China has been dumping the US treasuries. If you see the data points, they have been, but I think they are not successful. Since 11 years, they have been trying to do so. But still, their dependency, or in fact, they're pushing even the clients for that matter to make the payment in CNH or CNY. Why to do in dollar? You should do in our currency. We can give you some more discounts. So that is why they're pushing. But my take is, in the future, it will be like maybe 10 years or 20 years down the line, there will be no reserve currency. I think, people are moving towards domestic invoicing. Like, for example, we are starting with, like, the RBI has been pushing for INR invoicing. Similarly, all the countries, with time will try to push in for their own currency invoicing. So maybe 10 to 20 years down the line, I think it will be multi-currency reserve currencies or fiat currencies. A long story, I know, but I don't think in the near term a dollar will be replaceable that easily. I think there are too many complications and too many things to talk about. And for INR particularly, where we are not even fully convertible, I think it's still a
Yeah,
very,
we've got a
very
long way to
long
go. But
story.
China,
Yeah.
you're
Yes.
right, they've been working on it a long time. I
Yes.
think in 2016, they became part of the SDR.
Yes.
So everybody's got to hold some yuan to balance their reserves. And they, boy, don't write off China. They're
True.
always, even though it looks like they're sometimes fumbling, they come back strong. So it will be a long, long time, but I think we will likely see yuan invoicing becoming globally visible. Still
Correct.
not really visible.
Yes, I agree. And also on gold, this scenario, if what we are observing, usually we see that there is a risk on and risk off. In the particular scenario, everything is risk on. Like, for example, equities, all-time highs, almost gold, all-time highs, like the base metals, near highs, US 10-year treasury yields moving higher. So something has to correct. Like, everything may not go in synchronization that everything is like everything is absolutely clear. So as sir is rightly saying, that something has to correct. And I also personally believe that if something has to correct within these parameters, I think it would be equities.
Agreed. Yes. So now, so many things happening, so much happening in global markets, process being so volatile. Another question or another, thing to wonder is we have witnessed USD INR volatility at a decadal low. So, Kunal, I mean, what's your take on RBI intervention so far and going ahead? Last week we saw a hefty dividend being declared. Of course, it is going to help government in the fiscal and the other targets.
Right.
So, what's your take on this particular fact, this particular scenario?
Right. So if we talk about 2023, I think we saw inflows of almost around 1.7 lakh crores in India. That was the highest ever inflows which we have seen. But there was not much of an impact when we talk about dollar rupee. Somewhere also, if we see the FX reserves, if we merge both the flows as well as the FX reserves, we have bounced back on our FX reserves from the lows of $528 billion and moved towards the all-time highs of $648.7 billion. So this really first tells us a story that all the inflows are an opportunity for us in order to build our reserves. That has been happening. Second, also, if we talk about the FCAs, which is the foreign currency assets. So if we break down of the FX reserves, there are four parts: FCAs, which have grown from $509 billion to almost $570 billion. Then there is gold, then there is SDR, and there is IMF. IMF, like the contribution to IMF, which is a very smaller piece. In the three criteria of FX reserve, gold reserves, FCA, and SDRs have risen, particularly, obviously, the FCAs. which means the inflows which we are catering to or which we are getting from equities and debt is absolutely getting absorbed. Second, I think if we talk about the perspective of the import cover, because if we talk about the import cover at this juncture of $648 billion, and considering the inflows which we are projected to expect to come in from the debt flows, currently we are at an import cover of around 11 months. But I see FX reserves to further rise. Where I see importers and exporters somewhere are a bit comfortable between this 80 to 84 band. Plus the interest rate differential have narrowed. When the interest differential is narrowed, the average CAGR depreciation in last 25 years in dollar rupee was almost 4.5%. But now because the interest rate differentials have narrowed, I think the average depreciation may be around 1.5 to 2%. Until unless there is a war or any kind of unforeseen scenarios. So I think this inflows are getting absorbed. So I think still the dollar rupee may remain in this consolidation phase only, not seeing too much of spikes or a bottom. Secondly, if we talk about the RBI dividend, it's first important to understand that how this number and where this number comes off for around 2.11 lakh crores. So first, I think it's more because the RBI earned revenue from the VRR, variable reverse repo, which they conducted, the auction which they conducted in order to support the banks or the liquidity in the kind of when there was uncertainty in terms of liquidity tightness. So that was one reason how they increased. Secondly, it was because of the FCAs, which is the foreign currency assets, which grew from 509 to 570 billion dollars. Second, it was because of the sell of dollars by the RBI into the market, which earned them revenue. And fourth, it was because of the higher interest earnings on domestic and foreign securities. Because if you talk about FY 22-23, the repo rate or the Fed fund rate was around 2.5%. And now if you talk about FY 23-24, the Fed fund rate is around 5%. So there is an incremental income which contributed towards this higher dividend, which was never the case earlier, where the expectation for a dividend was almost half of it, maybe around 1.1 lakh crores. What is the benefit out of it? It obviously reduces the fiscal deficit for us by around 0.2, 0.3% of the GDP. If we talk about the budget, in our last budget, they were very clear that fiscal deficit should be lower from 5.8% of FY24 to 5.1% in FY25. So we are targeting that, and which this money can obviously reduce that. Secondly, because such a hefty amount is given, we don't need to borrow more. Usually our borrowing calendar is higher. Now, because our borrowing cost also goes lower, it definitely helps and adds to us in terms of assisting, the rupee as well with time. And third, this money obviously goes for infrastructure and spending, and which will contribute to economic growth. So I think it's a healthy sign. One last point I want to make here is one thing which people are not talking about is the CSR, which is the contingent risk buffer, which they have increased from 6% to 6.5%. So this CSR is nothing but, the savings which India has on any kind of rainy day. So basically, in simple terms, operational risk or any kind of credit risk or financial stability, this money is used. It is also a welcome step that we are keeping that risk buffer also into place by increasing by 0.5%. So yeah, that's my take. Like Jamal said, you can obviously guide us.
Couple of things. I agree with most everything you said. The one thing that I think is significant, is that you were talking about the interest rate differentials. I think what is more significant is really the inflation differentials.
Agreed.
I mean, the reason the rupee has been forever falling is because our inflation was so much higher. And full credit, really, to the Reserve Bank for really managing inflation to where now, I mean, on an ongoing basis, there's really no reason for India to become a high inflation country as it was. Of course, there is the volatility in inflation, food prices, monsoons, etc., etc. The other thing is, however, so that is giving them tallies. But on the other side, what I feel that RBI's intervention policy has been, they are holding it so tight. It's almost like they are lovers of them. They don't want to let go at all. Now, I'm saying that's not healthy. We just saw about a week ago that the rupee suddenly strengthened by 40%. How many exporters said, oh God, right? Because nothing was seen. If the market is completely flat, if there is near sort of dead man's heartbeat sort of volatility, people will intuitively come to believe there is no risk in the market. But that is the wrong situation to create. And in fact, recently I was just fooling around looking at the volatility curves of rupee, Thai baht, and Philippine peso. And if you look at the three of them, in all cases, volatility has come down. But the pattern with which the volatility has come down has been different. And made me think of another thing. You probably remember a few years ago when the US Treasury was pointing to India as a possible currency manipulator.
Right.
When Trump comes in, likhe deta hu, I mean, hey, it is a currency manipulation. Now, what is the impact of that? I don't know, because ultimately it's all politics. But I think more important than that, what is important is the error RBI is making is actually thinking that zero volatility is a good thing. In point of fact, it is a bad thing. And one other thing, that point you made earlier on that I want to comment on, which you were talking about the Fed, where the Fed is always broadcasting what they want to do, right? What they're going to do. Now, to my mind, again, that is a way of the Fed taking care of the financial sector's risk.
Right.
No, I'm an old man, but my father, who's older still, he used to have a great line. He used to say, the central bank should be like God. You only see them if there is a crisis. You know they're there, but you only see them if there's a crisis. Why? Because it's important that companies, people who are investing money, people who are doing business, are actually continually thinking about risk. But if the central bank, ye karne wala hu, and does it, I mean, I have a relative in Switzerland who was loving it. He made so much money. He's in real estate, and he would keep, normally he would borrow 3 years, 5 years. He kept borrowing short because he knew rates were not going up. So I'm saying this is also contributing to the continuing increase in inequality that we see. I mean, it's a long road, but I think that RBI, I hope they wake up to that.
Right.
Got it. Again, I mean, as you said that, if Trump comes in a power, yes, I mean, RBI will be questioned about being a currency manipulator. But the beauty is that the way they are doing it on paper, it is very difficult to, actually prove it. The kind of intervention and the kind of
No, just from looking at the volatility trace, you can see it.
Right.
It's clear. Anyway, that's neither here nor there.
Fair enough. Yeah.
It's not my job.
So now, let's come back to Pavilion. Let's answer that $1 million question. How will Indian equity and rupee will react under all three possible outcomes on 4th of June? So, Jamal, sir, please share your inputs, your take on that.
Me? Well, actually, Kunal, why don't you go with that? I'll come in later.
Sure, sir. So first, before we answer the main question, I think it's important to understand, what has been the historical data which suggests us. And then obviously we'll go to the inference, with Jamal sir answering at the end. So first of all, I think it's important to understand that the Nara of Ab Ki Baar 400 Par, how evident it is that it will hit. So if you ask me my personal opinion, obviously I'll give my probabilistic views as well. But personal opinion remains that it seems difficult. We go for a 400 plus majority. But in case, even if it is a 0.1% chance, and if this happens, because again, as I said, it's markets and it's politics, where irrespective, people like us may think and analyze maybe state-wise, having those exit polls at our own, analysis, but you never know how politics works. But in case if still it happens by 0.1%, I think it will be extremely bullish for equity markets, because I think if this really happens, we may see a 15 to 20% jump straight away in equities if standalone, maybe 400 plus seats, because it's important to understand how many seats they have contested for. If you talk about the last elections, they had contested, like BJP had contested for 437 seats. Before that, in the previous elections, 425 seats. And now in this scenario, this is the current elections, they're contesting for 441 seats. So we are saying that out of 441 seats, they will get 400 plus seats. which seems to be difficult considering the southern part, where the share of votes remain a bit tricky, and also considering the politics in Maharashtra, that has also changed to some extent. So taking those both belts into queues, getting 400 plus will be difficult. But if we talk about the three scenarios, one, the scenario like if BJP getting 300 plus and the alliance joining in, and we close around maybe 350, 360 seats, still the markets would be happy. That's my personal opinion. Where we see the equity markets seeing some kind of knee-jerk rally. I would not say a sustainable rally, because market always discounts things prior, and that is what we are seeing probably in the equity markets also. Today also we saw Nifty going towards 23,100, 23,200 band, and even Bank Nifty going 49,600 odd. So this obviously a pre-rally is being seen, but when this scenario actually turns into picture, would there be further rally or would there be a profit booking is a question. But as I said, if it is 400 plus, definitely yes, we may see a sharp rally. But if we are going around 350, 370 with Alliance, still markets would be happy. Maybe a 5% rally in Nifty can be seen, wherein levels of 23,600, 23,800 levels can be tested. On that front, if we are able to see those levels. Second view is, what if the BJP closes between 260 and 300? At that point in time, the alliance, if I add, so basically my assumption is alliance will get 40 to 50 maximum. So if I talk about 260, 280, which means we are closing around 320, with BJP getting into 320, 330 seats, where I see some moderate profit booking coming into picture. I don't see a rally into equity markets. So I would rather see a profit booking. And third scenario, if we are closing below 240 seats for BJP, so if we are counting NDA, maybe 280, 290 seats overall, considering the last elections in 2019, they had got around 303 seats to close in. And if we are closing below that number, I think markets will look forward for a sharp correction. As what Mr. Mecklai was also saying, that he is eyeing equities to correct, maybe. So that could be one scenario where equities could definitely be corrected if we are closing with the alliance around 280, 290, where we can see a 15 to 20% correction also, when Nifty can go towards 20,300, 20,400. But again, there are two rare cases of going maybe around 260 to 290 with alliance and going above 400. So personal opinion is we may close around, the election may close around 330, 360 overall band. One thing I want to highlight, both with respect to the FII flows, also with respect to rupee. So I have done an analysis where since 1999 elections, what has happened? So 1999, 2004, 2009, 2014, and 2019. In all these 5 years, irrespective whatsoever government has been formed, in the first week, rupee has always appreciated on an average of around 1.3 to 1.6%. That's on an average, irrespective of whatever government comes in and whatever number comes in. But if we again broaden our horizon to 1 month, rupee still have seen an appreciation only apart from 1 year, but to a range of 1%, like after the results to 1 month, I'm saying. But if we talk about 3 months from the date of result till 3 months, rupee has seen depreciation. So that absorption has happened, and rupee usually has seen a depreciation of around 1.6 to 1.8%. So similar kind of rally, because now inflows are also there. So we are talking in isolation about inflation, or maybe the elections purely at this point in time. But as we started our discussion, that it cannot be considered in isolation. We have to take global picture as well as the inflows which are lined up into place. So for the equity part, what has happened with the FII flows? So if we talk about from the last four elections, from the date of result of elections till the year end. So for example, in June 2024 till December 2024, similarly for the past 4 years, all past 4 years FII have been positive. They ended positive. Considering debt and equity all put together, none of the last four elections we have seen negative FII flows. So, but yes, the flows could be maybe flattish, maybe around 4 billion to a maximum of around 32, 33 billion dollars. Third, if we talk about the Nifty returns, if we talk about the last five elections, the Nifty results have also sounded positive from the date of result till 1 year. There was only 1 year, that was 2019, where we saw a negative 22% return. And that was also because of COVID coming into the onset. and there was a knee-jerk fall into the equity markets in 2019. Later, again, a pullback towards the all-time highs, which we are seeing. So for me, I think if you talk about numbers specifically, for rupee, I would personally believe that we may see some appreciation first, irrespective of whatever government or whatever number comes into picture, considering the 1 month horizon. With time, because there will be several other factors like rates trajectory plus US presidential elections, and how the European Central Bank behaves for the rate trajectory being so dovish at this point in time. These three factors will add on to a decision that where it plays. So for rupee, if I talk about levels which possibly the viewers may be more interested into, the first level I on the lower end is 82.65, from where the rally towards 83.55 happened. And in case if we are able to see those levels because of the election or a culmination of factors, then we may move towards 82.20, 82.30 band. While on the contrary, obviously the immediate resistance still remains at 83.35 levels. In the worst come worst case scenario, first test will be the NDF high levels of 83.72. So markets like in the onshore market have not tested, but NDF have obviously tested 83.72. So for me, that acts as a very crucial resistance. A break of it due to a very worst number of seats coming into picture can open gates. But again, as well as I said, that would be temporary. So my view probably would be more on the appreciation phase. And for the markets, which is the Nifty or overall, so I think the rally, because we are already seeing a pre-rally, and investors and the FII flows probably remains this time the DIIs have been very supportive. Irrespective of the FII outflows, the DIIs are showing too much of optimism, which is good for us, definitely, yes. But particularly for retail segment, I think one has to be very cautious because the India VIX, as we are seeing, it has been around 22, 23, which is scary. It's like, it's like, two-way movement, maybe 10 times in a day, which can be very crucial for retail perspective. Algorithmic trades are very, very high at this point in time. So on the right side for the levels, if I talk about for Nifty, I expect in case on a very positive scenario, 23,800 to 24,200. While in case if we see any kind of worst outcome where below 300 seats, then I see a sharp correction by around 15%. So moving towards less than
And
21,000.
It's
And on
interesting.
currency, basically, you are saying that whatever euphoria or the shock, the whatever action happens, whatever reaction happens in FX market would be temporary. Is that what you are suggesting?
So
Because
basically,
as you said, historically, that is how it has been.
correct. So for me, I think if in case we are seeing a sharp appreciation, I'm sure RBI will step in and put.
In fact, they are probably already in.
Yes,
Always.
so
My
correct.
mind, the fact that it has not gone
Mm.
below stronger than 83 right
83,
now.
right.
So, your research is interesting, but Bhajan,
Research is research,
tomorrow is
obviously.
another day. So just
Absolutely
because
right.
it's happened 50 times, there's
Correct.
no reason why it will happen the next time.
I completely agree.
My take is that I believe we're seeing sort of people jumping the gun, right? So I'm talking about equities first. And I think that even if there is unless there is a blowout performance, but my point is, even if there is a blowout performance, the market is overpriced anyway.
Yes.
So even if the equities rise, I think they will not rise much more.
The
And
upside is limited.
they will need to steady because they're overpriced. And people are buying now. Uh, on however, having said that, the good news about India's equity markets is you get it from the cricket match.
Mhm.
SIP, baby.
Absolutely right.
SIP, India's
That
stock
flows.
market is just going to rise and rise and rise and rise. So while there will be volatility, which is the nature of the beast, you can't stop it.
True.
That's a good thing. That's something we're very lucky, where we are not really that dependent on global flows anymore. I believe the FII holdings in the market are like 15, 16% now. I think at the peak they were 20 plus.
Yes.
Of course, having said all of that, that the equity markets are great long term, which isn't really telling you anything you don't know. What's going to happen tomorrow, I don't know, and you don't know. The rupee is more interesting because the debt flows will continue, irrespective of, I mean, they may be a little bit tapered if there is a quote a negative election result, say that BJP doesn't do well, or there is drama globally, where people say, "Nahi, Baba, wahan nahi jana." But my feeling is that those debt flows are going to come.
Yes.
So the rupee will be, it should be protected from falling to 84, 85, even if there is a major blowout globally and or a major blowout globally. So, I guess let's wait for the 4th of June.
Right. So just to add, like I personally believe that, as you rightly said, these inflows will definitely be coming in. And so my personal analysis says that FX reserves by the year end will go towards $680 billion by the end of 2024. So that's my personal analysis. Again, it's just a personal.
That is implying that the
inflows
keep coming and RBI keeps buying.
Yes, that's what I personally see.
Right, but that is assuming there is no trauma.
Yes, absolutely. So obviously,
there is no trauma one way or another,
Right.
But please, Baba, since you seem to be friends with them, tell them to allow a little more volatility.
No, I think you are a veteran than me. I am just a learner, so I think
you guys are you wear a nice suit and all. Look at me.
It doesn't matter. It's about the content that matters.
Well, great. I think we've covered pretty much. Dipti, you have any other thoughts or questions you want to toss at us?
Just about, interestingly, in Business Standard, couple of days back, I read that, there was one, not in the paper, but on one of the interview bite that they have taken, quite interesting point they had, made over there, that winning a race is important. By how many seconds or by how many meters is not really, that doesn't really matter. And whether financial markets would actually, follow this logic. So to that, the reason, in spite of that, we are looking at, we talked about 3 different possibilities, or BJP on its own very comfortably, or with the NDA as a whole, and then the opposition change in power. So the reason being, in 2019, one of my connect who manages global funds, so that person told me that in a matrix there is a one factor which is called, which is related to political stability. And with the percentage of the comfortable, one-sided clear verdict, the tick mark happens for that particular destination, suggesting that there is a strong political stability over there. Now, whether it is NDA or India alliance, opposition alliance, what matters is, where there will be a stability in the policies and all of that. And once in that matrix, once you have all those ticks, obviously people who were earlier not allowed, allowed to invest, and where that country was not a preferred destination, allowed destination, automatically those doors are open. So considering that, of course, the outcome on 4th of June really matters, with what, what, by how much margin, who comes in power and all of that. So yes, that is going to be quite interesting to see. I think we can take some questions. We do have some time to spare, so we can take some questions from the audience. We see some hands raised. So if you could.
And in fact, if anyone wants to share their views, obviously the forum is open.
Yes.
Because ultimately it's more of an interactive session. No one is right or wrong. It's about, so market will always be supreme. So if anyone wants to share their views, obviously this platform is for you as well.
So the one question that I can see is, oh, of course we can have that. The question is, can we have such sessions, say, once in a month? A big help for us. So of course we would be more than happy to do it. Any other question?
Kabir has his hand up.
Yeah, so the question is, what are your takes on, just a minute.
Why don't you let him talk? Why don't you unmute?
Yeah, you can unmute
What
him.
are your takes on PSU stocks which are in picture after Modi's interview in the press? So have you tracked any particular PSU stocks which you would say would do well depending upon the result?
So if you ask me, I think I would not specify any stocks, but then the only thing I can think of is certain sectors which can be under track. One is obviously defense, second is manufacturing, third is definitely PSUs and the banks. So these are a couple of sectors which one needs to keep an eye on. So I would not, again, as I said, I would not go stock specific. I'm not an analyst particularly, to suggest any stock.
Got it.
But yes, sectors is what we can think of. And
Now,
defense and power, yes.
right. Now, Mr. Sunil Roy wants to ask, will Russia and China continue to buy gold?
I tried to sell some last week, but they didn't buy. No, like I said, China has been one of the biggest buyers. And as I said earlier, my belief is that, whoever you are, at some point the price has to make a difference. And while at $1,900, it was clear to me that gold was going up. At $2,400, I ain't buying, and I don't think I really think it's going to peak.
Now, another question is to Jamal sir. What is your view on USD INR levels in case the India bloc comes to par? Can the full effect be absorbed by inflows?
Sorry, can what?
Can the full effect of, if there is a negative, if there has to be a negative impact on currency, can that be absorbed by the inflows? So the question is, what is your view on USD INR levels in case India bloc
If
comes in a par?
if there is a major, call it a trauma for the market, either, of course, RBI will be there. They've got lots of money to protect. But, ultimately in life, you don't just throw money on the table. If it looks like there is a big wave, you let it ride for a while and then try to come back. So I think you have to recognize that, it could get to certainly 84.50, but I have no real idea, but it could. So again, I come back to my point about volatility. If there is more volatility, people are not as terrified. See, right now, Baba, kya hoga?
Right.
Just to add on to sir, so I think my observation is the more narrower rupee trades, the more riskier it is.
That's it. Absolutely.
Because, at times, not at times, in fact, in case if you see the last 5 to 7 years, RBI does intervene, definitely, yes. I think RBI it's himself have been vocal about it, that they do intervene in the market. But once they go sideline, that has been always the case. We see a 60-70 paisa move one way, either which ways, either it is appreciation or depreciation.
This is the nature of markets.
Right.
When DXY took off, it started when the volatility had reached a very low level. Not this low, but there's usually the one way you can never really pick a turning point. But one way is to track volatility troughs.
True.
Now, when the volatility troughs, you don't know it's actually the bottom, but when it starts to turn up again, the market can move quite rapidly, which is again the same point we've been making.
Right. So my advice to the person who has asked the question is follow the risk management policy rather than trying to higher level. If you're an exporter or importer, it's important to understand the costing which you have from your own business rather than trying to make FX your business. There is a very wafer thin line between hedging and speculating. People think that they're hedging, but somewhere they start speculating. So if you know the cost, don't think much about currency because that's not your business. That's not your core business. So that is one, and start hedging in a staggered manner. Understand the forward premiums because the forward premiums are almost around 1.7% annualized. So keep on hedging at 30-40% on a staggered manner. That's what my suggestion would be, rather than trying to eye a top or a bottom.
But that point of the low forward premiums is also an issue. Now,
Absolutely,
that is not related to RBI. That is related to the fact that our inflation is now, comparable with the West. But because premiums have been so low, importers say, even though it's almost free to cover, this way rupee is not going anywhere.
Correct.
And right now it's strengthened. So why should I buy?
Right. And
You
same
know,
goes with the exporters because the premium itself to
no,
receive is so
export,
less.
but it's the same story. And exporters
Right.
always say, "Kya milta hai, chhod do. I'm used to getting 3%. You
Absolutely
see
right.
what
Yeah.
happens." So
Right.
maybe just to keep things balanced, maybe
Mhm.
the rupee will weaken. Maybe the election will go that way. Or maybe the global markets will crash. I don't know.
Thakkar has one question. Consider the scenario: U.S. inclined to reduce rates because of ensuing election, robust inflows because of JP Morgan bond infusion, and strong Indian government. In this scenario, so basically he has listed out all positives. So in this scenario, will rupee breach 82?
So if you ask me,
100%. No, I mean, nobody knows, but clearly, if everything is positive, it's got to break below 83. It's already at 83. 82 isn't very far.
okay.
Yeah, Kunal, you
Yeah.
were saying something.
Yeah. So if you ask me, only if we consider these three scenarios in isolation, rest constant, then possibly yes. But if we combine the other factors and the RBI's role into it, I think these inflows may be absorbed. So it will be probably if it goes 400 plus seats, that creates a more optimistic scenario where rupee may go below 82. So I mean that's my take as of now. I would say that somewhere 80 to 82.20 remains a very good support zone.
But you see, Kunal, one of the things
Hmm.
about absorbing inflows ad infinitum,
Hmm.
see, ultimately, let's not forget, RBI's primary job is containing inflation.
Yes.
And this is more true in India because it's a poor country. So you just pull all the money in,
Hmm.
bunch of liquidity into the market,
Hmm.
inflation is going to be a problem. I mean, from all the hawa about the elections, everyone forget the elections. You talk to your people who work in your house, talk to your drivers, talk to your wife. I talk
Right.
to my wife, and prices are an issue.
True.
Even though the inflation number which RBI manages is maybe reasonable, but on the ground it's very high. So
Yes.
there are dangers to absorbing all of the inflows.
And everything comes with a cost. So
Right,
yes.
right. And I think it's very important that we need, I mean, RBI knows their job, it's not my job to teach them. But we need to understand that inflation is, in India, inflation is more of a fundamental issue than, let's say, in the US.
Right.
Because there are poor people there, but nothing like we got.
Hmm. And just to add, like, so usually we say that शेर आया और अचानक एक दिन शेर नहीं आया. So it's kind of a same story where the question was asked that we are expecting that they will intervene. You never know. One fine day, they are sidelined and we see a move towards the left. So it's not obvious. Obviously, yes. And markets will never be obvious.
That's very interesting. That reminds me of something from a long, long time ago. There used to be a guy, he was ED at RBI, he's retired now, a guy called Padmanabhan. And I can't remember what year it was, many, many years ago. And the rupee suddenly weakened sharply. And he said, "You haven't been monitoring it. We had slowly stopped intervening and you weren't watching." And boom, it's gone.
Right.
So, but again, that's not how they should function. They should be a little more balanced. But hey, like I said, they're doing a lot of great things. This is one thing they need to more.
One more question from Ajay Agarwal. How is European grayish market and ongoing Gulf worries do impact our market?
Sorry, what was the question?
How is European grayish market and ongoing Gulf worries do impact our market?
Well, we've sort of addressed that. It's remarkable that it's not had any material impact on oil. And and again, while, as Kunal pointed out, the central banks are beginning to diverge. It's not everybody doing the same thing. I don't think major changes in Europe are that definitive for us. I think major changes in China are more important for us. In fact, one of the things that little analysis I'd done some time ago is that whenever the Chinese yuan weakens, the rupee weakens with like a 70% correlation.
Correct.
So, we really need to look at, I mean, it's become America and China.
Right. One more question for Kunal. Is government doing anything to bring food inflation in control? If yes, is it not working? And if no, what should be the steps that could be taken? You have actually covered a bit about that, Jamal sir.
Right.
Kunal, you have anything to add there?
So basically, for me, I think the net import bill for India for FY25 will be around 100 to $104 billion. In fact, I would rather appreciate the government the way they have, taken as we already discussed, that we got crude at a discounted rate from Russia, and which definitely boils down to the cooling off of current account deficit numbers. So I think considering that, I do not see any pressure at this point in time, particularly from the domestic perspective, that steps are not taken in the right manner. I think more of an independent call, irrespective the entire economies were against, but we followed what was important for India as a country, considering the 70 to 80% of oil imports. So in fact, also if you see in March 2022, the oil prices were at $140 per barrel, where there was an onset starting of the Russian-Ukraine war. So from there also, if we see, I think we are still, quite contained in terms of our global, domestic macro numbers. So I don't feel personally any kind of pressure or any wrong steps where have been taken by the government in order to tame out the domestic macro numbers. So I think those are quite in sync according to me.
Maybe
That's it.
one more last question, perhaps.
So one last thing, Dipti, just one thing which I want to add is we did not discuss why one of the more major reasons why crude is also lower, because if you see the EAI numbers, the energy information, and also the API, that is the American Petroleum numbers, it clearly states that there is more supply and the demand is less because the industrial demand for oil is comparatively lower as compared to good times. That is
Right.
also another factor apart from the geopolitical risk. Even there, oil is trading still comparatively lower.
Right, and it's a cause of concern also because that indicates a slowing down of economic activity. So that's
Yeah.
what it is. One question on RBI's action: are you seeing a buy sell being conducted because of the improved dollar liquidity post infusion?
So buy sell swap, you're
Buy
saying,
sell swap.
like
Yeah.
the way they did for $5 billion in the past.
Right. Right. Right.
Personally, I don't see it. Maybe Jamal sir can highlight, but as of
What's
now,
the
I'm not
question
seeing it.
again?
The question is about do you see that buy sell swap which are conducted because of the improved dollar liquidity post infusion of into a JP Morgan uh,
Well, I think that, again, in another context, Kunal pointed out that markets preempt, right? So there's been a lot of debt inflows coming in before the JP Morgan date.
Yes.
So one of the things is that when the date opens, the new people who come in will simply buy debt from other FIs. So it will not really necessarily be fresh money coming in. But I guess they've got to balance dollar liquidity and rupee liquidity. So that's probably why they're doing that, and of course the value of the rupee.
right. I think we have covered. I mean, we will be sharing our contact details. So if anyone wants to get back to us, write to us, please feel free to do so. So it was a wonderful talk, and I'm sure today's discussion will help all of us in engaging our risk better under whatever outcome you are personally rooting for on 4th of June. And I thank both the participants, both the speakers for their time and valuable insights on the subject. And once again, I thank you all for joining us. Now, before I conclude this discussion, actually, I would like Jamal sir to conclude this with his famous, non-market related quote, perhaps. So I would like you to conclude this.
Hey, darling, I have only one thing to say about markets, and it's sort of, I used to be on TV a lot, right? But I'm not anymore. Why? Because I know one thing for sure, and I will always say that, which is I don't know what is going to happen tomorrow. And nobody knows what's going to happen. Which is why I will relate to something Kunal said a while ago. Don't try to figure out the market. Manage your risk, do your business and make sure that you manage your risk. Don't think about what is going to happen. I mean, it's fun to think about the market, but I think most people who think about the market, unless they are professional traders, most people who think about the market lose money. So don't lose money and don't think about the market. That's my parting shot.
Great. Thanks a lot. Thank you all.
Thank you.
Thank you very much.
Thanks, Kunal.
Great. We had so
Thank
many.
you so much.
We'll do it again.
Yep, sure.
Lovely. Bye.
Bye-bye. Thank you so much, everyone. Thank you. Thanks,
Bye.
Dipti. Thanks, sir.